I think it's important, and what we've always tried to do, but I'm trying to give a greater line of sight for the readers, the audience, is to draw a greater line of sight between the economic fundamentals and what we may see for stock returns over the next several years. Now, we're showing 10-year numbers, but the fact is the next 3 or 5 years is the same sort of distribution and returns. That's important to remember. And so by the headline we have, when you add up all the possibilities that we can possibly see in the world, 10,000 more future worlds in 2026 and beyond, you have a more muted return. You see 4 or 5%. We're generally pretty constructive on the equity market. What is dragging that down in particular is the large cap growth companies, which is ironic given our AI economic assessment, but it's actually very consistent with past investment cycles, so we'll get into that. It's actually, it may sound counterintuitive, but it's relative to the prices being paid in the very sector that's being transformative. But I think when you look at the most likely outcome, it's generally supportive for financial markets in general, both fixed income as well as equity, particularly outside of large cap growth. And so our baseline, and you'll see it if you're showing it on the screen, is it's not like historic, like stock returns of 8 to 10%, which we rarely ever get in 1 year, but we've gotten it on average. But relative to inflation, it's not bad. It's like 4 or 5%, real, and that's based upon Vanguard has among the most, I would say, from a statistical standpoint, among the most bullish from an economic perspective, given our analytics over the next 4 or 5 years for economic growth. Yet we are at the lower end of the financial market stock returns. How is that? You'll see on the screen, you saw it's that 30% odds. We are still too early in the AI assessment. When we do our projections and our algorithms, there is still a 30% probability. I wish it was lower. Maybe some wish it was higher. I don't know what. That AI is not transformative enough along all of its 3 dimensions: the ability to automate, the ability to augment the work we do like a computer, and most importantly, the ability to create new industries and where's the next medicine that AI has created? I'm still waiting. And again, we're fairly constructive on AI. So because we're early enough in the investment cycle, there's still a 30% odds that we all use AI, but it's like social media. It doesn't really drive economic growth. And when you see that world, that's effectively a lost decade, given where valuations are for U.S. stocks. So it's not just, hey, we think the market's a little overvalued. I'm trying to unpack for you. When we look at risks, and from a multi-asset portfolio perspective, we're generally constructive, but that's why it will, whether you're bullish or bearish on AI, starts to push you a little bit away from technology, certainly into fixed income because of high real yields regardless. Why should I take equity risk with high real yields? But you can see the risk distribution. Yeah, there's roughly a 10% odds. It's even better than we think from an AI transformation perspective. You could grow into the valuations, but so generally constructive, but that 30% from a risk management perspective, as well as the baseline says, let's not get too carried away in the Mag 7 in the large cap technology companies. And that's why I'm actually excited. Our conviction is growing in areas outside of that, particularly over the next 5. If you give it 5 years, I think it's pretty exciting.